The world is on the brink of experiencing a major war in the Middle East. The Japanese stock market is crashing, and the US market is on the brink of a potential crash. In this video, we're going to be analyzing the major factors that could lead to a major stock market decline in the US in the next few weeks. By far, the biggest factor that could trigger a major decline in the US stock market would be the development of a major war between Iran and Israel. There have been a tremendous number of developments in the Middle East in the past couple of weeks. First and foremost, Israel has been on the warpath, on the offensive, since there was an attack on northern Israel, which killed 12 Israeli children. Israel has taken a number of very significant actions. First of all, Israel carried out a very precise aerial strike on an apartment building in southern Beirut in Lebanon, in a neighborhood which is a stronghold of Hezbollah, killing one of the most important leaders of Hezbollah. Second, there was an assassination of one of Hamas's major leaders while he was visiting in Iran during the inauguration of the new Iranian president. This is an unprecedented attack on Iranian soil. And third, there have been a series of attacks that have occurred in southern Lebanon, Syria, and Iraq on the part mainly of Israel, but also on the part of the United States, particularly in Iraq. Israel carried out a massive aerial bombing on a port in Yemen controlled by the Houthis. This was a massive destruction of a major port controlled by the Houthis of Yemen. And so Israel has struck some major blows against its mortal enemies, which it calls the axis of evil. And it has crossed some major red lines in carrying out these strikes. On the other hand, the members of the parties that like to call themselves the axis of resistance have been humiliated. They have suffered major losses, and they are looking for revenge. Iran, Hezbollah, and other enemies of Israel have already announced that they are going to be carrying out major attacks against Israel in the next few hours and days. The only question is, how big and how devastating are these attacks going to be? On the one hand, if these attacks don't manage to do a lot of damage, Israel may choose not to respond too harshly to the attacks. We could have a situation sort of like what we had in April. On the other hand, if, as it is rumored, the enemies of Israel carry out massive attacks and they manage to get guided missiles in, bombs in, that hit civilians, that hit major economic or military infrastructure, it is most likely that Israel will respond extremely harshly, particularly against Iran, and this would trigger an all-out war between Israel and Iran. In particular, Israel will be going after Iran's nuclear facilities. If there is even moderate damage to Israeli civilians, to military installations, or to civilian infrastructure, it is my view that Israel has already decided that it's going to try to take out Iran's nuclear facilities. For reasons that I go into in detail in 2 videos that I'm linking here in the description, in the event of a war between Israel and Iran, we can be rest assured practically that there's going to be a massive spike in global oil prices. Now, if you want to understand why it is that a war between Israel and Iran would cause a massive spike in global oil prices, please watch those 2 videos. But historically speaking, when there is a massive spike in global oil prices, this causes major declines in the US stock market, and it also tends to trigger recession in the United States. And as we're going to discuss in a little bit, economic data in the US has recently been fairly weak. And so a major spike in oil prices, a major oil shock, would have the effect of pushing an already weakening US economy into recession. And in every single recession in the United States, there has been a major decline in the stock market, usually a bear market where there's a decline of 20% or more. The second contributing factor that could lead to a major downturn in the US stock market is the fact that the US economy is slowing. Now, a lot of people are concerned that this slowdown is getting very dangerous and that we're coming close to the point where the US might be at risk of recession. Now, I personally don't think that we're all that close to recession. Today's employment data, which a lot of people were scared of, did show a pretty significant deceleration relative to last month, but employment is still growing. In addition, I think some of this data was actually impacted by Hurricane Beryl. And so some of the weakness in the data may have been somewhat exaggerated. Same thing for the industrial production data that we got in the ISM surveys that show that the US industrial economy may actually be contracting at the moment. In any event, the fact that the US economy has slowed, and we don't know if the economy has perhaps slowed to a point which is dangerously close to recession or that it's simply slowed to a slightly below average pace. Either way, generally, it's important to keep into account that the US economy doesn't go into a recession unless it's pushed into recession by some sort of a shock. And so that's why my previous point was very important. If we get an oil price shock at a time when the US economy is decelerating and the rate of growth is below average, that could actually push the US economy into recession. So the combination of a weakening US economy and an oil shock could push the US economy into a recession. And if the market starts worrying about the possibility of a recession, the market will start worrying about a major decline in earnings growth, and that could actually trigger a major decline in stocks. As I mentioned before, during every single episode of US recessions since World War II, a recession has caused a major decline in the US stock market, and it has usually caused, with very few exceptions, declines of 20% or more in the US stock market. A third major factor that could contribute to a major decline in US stocks is what's going on globally, particularly in Japan. In Japan, there has been a massive meltdown of the Japanese yen. This type of currency meltdown hasn't occurred in many, many years, and it's creating a great deal of instability. It has caused a lot of volatility in Japanese interest rate markets, in Japanese bond markets, and it is currently causing a massive crash in the Japanese equity market. We just got a flash crash, a decline of 5% or more on a single day in the Japanese market on Friday. And this is on top of some major declines that had happened just in the last few weeks. So Japan is in the midst of a massive meltdown in its markets, in the equity market, in the bond market, and in the currency markets. And this is going to have global repercussions, particularly with regards to a factor which is called the unwinding of the yen carry trade. This is one of the most important trades that occurs in global financial markets, and the unwinding of this yen carry trade could have massive effects on global markets. Now, the third set of contributing factors that could contribute to a major decline in the US stock market are technical conditions. Now, let's review some of those technical conditions right now. In my last video, which I'm also going to be linking here to the description, I go over in great detail a lot of these technical details. So I'm going to assume that a lot of you have probably seen that video so that you can follow along with this analysis a little bit more closely. But first of all, the first thing that I want you to see here is this very important trend line, which was broken back here. And in the last video, I mentioned to you guys that as the market reached this very important support zone, which is right around here, this gray area, a big support zone, as it reached this area, it would most likely bounce. And I did mention that the primary area that such a bounce would probably target would be the underside of this trend line. And I mentioned that it would probably fail here, which it did in a very dramatic fashion yesterday, where we had a big reversal day in the market as the market here, the S&P 500, rallied right up to this resistance point, failed right here, bounced back down, reversed to the downside. And then today we had a very big gap down. Now, during this down day, we got into this support zone. And what we would expect is that this support zone would hold up and that it wouldn't just crash through it. And so it did actually hold up, and it actually managed to bounce right back to the upper part of this support zone. So that's actually where we are right now. Now, a couple of other things that I want you to see here. First of all, the market breaking the 50-day moving average. This short-term moving average is a big momentum indicator. And when this short-term moving average was broken today decisively, that triggered a lot of selling, particularly by CTA. These are momentum traders. Now, there's a second really big level that's right around the 100-day moving average, roughly around the level of 5250, where if we penetrate below that, that could also trigger a tremendous amount of selling. And we can certainly go down and test the lower end of this support band right here. Now, as I mentioned in my last video, I think that without a pretty significant fundamental catalyst, this decline is likely to halt right in this area. And so, however, if we do get a fairly significant fundamental catalyst, we could break the support area and go all the way down here to this major support line right here, which happens to intersect practically with the 200-day moving average. So what we're looking at right now is that after this major sell-off on Friday, the market has hit a support zone. For the market to continue to move to the downside, there's probably going to need to be some major catalysts. But we do have some major catalysts at hand, as we described before. First of all, we have this situation in the Middle East with Israel and Iran on the brink of a major war. That would certainly be enough of a catalyst if the conflict is major to get us through the support zone and testing down in this area. The second factor that goes along with it is the major weakening of the U.S. economy that could cause concerns about a hard landing. So here you see that the technical condition of the market right now is okay because it's supported around this region. But if we get some fundamental catalyst, we could get a trigger that would spark some massive selling by CTAs, which I described in my last video, that could dump up over $100 billion in stock as these different technical levels are triggered. And this could, of course, create a type of flash crash scenario where we could have a major decline of 5% or more on a single day. Now, another major technical constituency or another group of value insensitive traders are what we would call vol control traders. Now, these traders basically sell all their holdings when implied volatility rises above certain levels. Now, a lot of these vol control sells have already been triggered today since volatility rose above 20. However, some of these systems use some sort of a moving average, and so the moving averages are not yet above key levels. And a lot of these systems actually get triggered when implied volatility is above 30, which we haven't actually surpassed yet. So if we get another major decline and some catalysts in the next week or so that take implied volatility above 30 on the VIX, the VIX, we can expect that this is also going to unleash some more technical selling into the market. So let's discuss a final contributor to vulnerability in the US stock market, and that has to do with valuation. As you remember from my last video, one of the things I pointed out is that once value insensitive investors start selling, other value insensitive investors are not on the other side of that trade to buy those shares. The only people in general that are going to be on the other side of the market are value sensitive investors. And so they're looking to buy stocks at reasonable values. The problem is that with valuations being so high, particularly in certain segments of the market, prices need to go a lot lower before value sensitive investors actually become interested in buying stocks and can become a major constituency that can absorb all this supply coming onto the market. And one way to illustrate this, and there's very many ways that you can illustrate valuation of the market. But here's a pretty interesting one, which takes a look at the implied equity risk premium. Now, what the implied equity risk premium measures is the amount of risk that the stock market is pricing in when it's assigning a valuation to US equities. What we see is that historically, over the course of this particular graph that goes back to January of 2003, but even if you go back even further, this number is going to be even higher. Average equity risk premium on US stocks is about 5.22. And this is pretty consistent with a long-term historical average. Now, what we see here is that we have unprecedentedly low equity risk premium in the US market right now, 2.52%. This means that investors right now implicitly are only demanding 2.52% more real return on investment as opposed to the real yield provided by tips. The equity risk premium here is being calculated based on the earnings yield of stock minus the real yield on tips, which is the real long-term yield. And so the implied equity risk premium, which is what's left over after that, is this 2.52, which is massively lower than the average. And what that shows is that there's very little fear. There's very little risk being priced into the market, which means that stocks are actually quite overvalued. And so if markets start pricing in more normal levels of risk, this could cause the market to go down 15, 20, 25, 30%. This difference in the equity risk premium actually amounts to over 30% decline to get back to historically average levels. So let's review right now where we are in terms of a risk of a market crash. First of all, from a technical analysis perspective, the market is currently sitting on very strong support levels. In order to get below those strong support levels, we would need some important fundamental catalysts that would unleash some selling and cause these technical support levels to be broken. Now, the thing is that we do have some very important catalysts that could potentially be impacting the market in the next few days and weeks. By far, the most important of these catalysts is the situation in the Middle East in terms of a potential major war between Iran and Israel. If we get a major war, all of those technical support levels are going to be broken, and we're going to get a massive amount of supply onto the market, pushing the market substantially lower until fundamentally oriented investors become interested enough and become a large enough constituency that they'll actually start absorbing some of that supply that would be coming onto the market. Now, we have some other catalysts that are perhaps not as dramatic, but still potentially important. We mentioned the slowing of the US economy and the concerns that that could be causing about hard landing. We have the instability being caused by the meltdown of the Japanese yen and Japanese markets more generally. We have the fact that Kamala Harris is rising in the polls, and markets are really not liking that very much because markets have very little idea of what her policies are going to be. And the very little that we know of what her economic inclinations are, the market doesn't seem to like it. So we do have a number of potential catalysts and factors on the fundamental side that are tending to unleash some supply into the market. And if we break below some of those key technical levels that we reviewed, the market will be in a lot of trouble. In the next few days and weeks, I'm going to be looking at all of these fundamental and technical factors like a hawk, really following them very closely to see if we're able to get some firm signals indicating that we might, in fact, get into a crash type of scenario. Now, that type of scenario would provide tremendous opportunities from a trading standpoint, from an investment standpoint, in terms of being able to go short the market, to be able to take bearish positions. But perhaps even more importantly, that will provide a golden opportunity to take some long positions from a long-term perspective. So I want to encourage you to do a couple of things. First thing, subscribe to this channel so that you could continue to follow my analysis and be able to detect the signals that are going to be given both technically and fundamentally to be able to take advantage of this situation. Second thing, subscribe to my service so that you can see what are the positions that I'm taking in my portfolio in order to take advantage of this situation. All right. So look forward to seeing you next time. Thank you.